Welcome to our first Taking Stock video for 2022. And joining me today is Lincoln Fund's Senior Portfolio Manager, Matthew Swartz. Happy New Year to you, Matt, and thanks for your time today.
Happy New Year to you too. Thanks, Kien, and thanks for having me on.
And we hope you are all safe and well during this health pandemic. Well, equity markets have begun the year with significant volatility. From its highs to lows, the All Ords Index has dropped 11.6%, while the US S&P 500 index has fallen 12.4%. But it was a tale of two halves, with the growth areas of the market punished the most. The small ordinaries, they fell 15%, and the US tech index, the Nasdaq, dropped 19%. So this compares to the larger end of the market, such as the ASX top 20 and the Dow dropping by only 10%. And during periods of high volatility, there tends to be a flight towards safety. That is, movement towards the larger and more mature businesses, such as many of our star income stocks. And last week, Tim sent out an important message providing insight into the current market environment and how investors should be positioned. In his message, he emphasizes that volatility should not be feared, but rather embraced. And investors should take advantage of the share price weakness in quality growth stocks, which should rebound at some stage in the future. And this message can be found under our resource center. And Tim is looking forward to joining me next week to provide his insights. In the meantime, we have begun to see the market retrace from its January lows.
Yes, although it's retracing, it's certainly been a miserable old start to 2022, hasn't it? And the catalyst for the aggressive moves we've observed in recent weeks has been increasing inflation prints and the Federal Reserve's guidance on how they intend to deal with it. So the spike in the price level has been caused by a multitude of factors, but the most prominent being significant supply and demand imbalances caused by the pandemic. And at the risk of oversimplifying things, I thought I'd try and walk you through exactly what I mean by that. Now, firstly, the pandemic forced billions of people into isolation for various periods, and many millions were unable to work. But government relief packages allowed us to keep spending. It was simply unprecedented, the level of fiscal stimulus that was injected into global economies. And spend it we did, but importantly, our consumption habits changed quite markedly. Instead of purchasing on services like we used to, we started buying more and more things. And most of the things that we purchase are obviously products of the global supply chain. And the supply chain obviously had a lot of difficulty working through the unusual shift in demand. And to make things a whole lot worse, we've faced impediments in the form of staff shortages, increased border controls, port disruptions, and rising energy costs, all manifesting into higher prices we're experiencing today. And the Fed has obviously changed its tone in recent weeks, suggesting that to combat rising inflation, it intends to begin tightening monetary policy sooner rather than later. This switch in tone has caused investors to move into a big risk-off mode. But as we emerge back to a semblance of normal life, we think that these inflation pressures will naturally ease. So we don't think the Fed will need to move as aggressively as the market is currently fearing. And hence we believe that investors remain calm, look at the fundamentals and not panic.
Yeah, Matt, and these COVID-driven imbalances, they've led to some profit margin pressures across many companies, specifically in our coverage universe, with recent announcements from healthcare company Ansell, the retailers such as Accent Group, City Chic, and even our miners, including Fortescue Metals, South 32, and of course, most of our gold stocks as well. Now, we expect this to be a continuing theme over the reporting season as we assess the viability of the companies in sustaining their profitability, such as return on equity and net profit margins.
And as many would have noticed, the selling has been most prominent across our growth portfolios. Growth stocks are most sensitive to a rising interest rate environment because their share prices are a function of the present value of all that future growth in earnings and cash flow that we're expecting. And the present value of money reduces as interest rates increase. And some of our growth stocks in our portfolios, particularly in the US, have come under enormous selling pressure. And we see this as a case of the baby being thrown out with the bathwater, that the selling has simply been unbelievably indiscriminate. Some of the great growth stocks in our portfolio with a very long runway for sustainable growth are being sold just as aggressively as the unprofitable, highly levered speculative end of the market. So we see this as an exceptional opportunity, although the volatility is unlikely to go away in a hurry. And we understand from history that these rotations away from quality growth tend to be fairly short-lived. We know that fundamentals dictate share price success over the longer term.
Yeah, that's right, Matt. And after digesting the latest reports from the Fed and RBA, the market is now expecting the cash rates to start rising this year, with the US guiding for as many as 4 hikes in 2022. But the RBA, they were far more balanced in their tone, indicating their preference to be patient on hikes. However, the longer term rates are still expected to cap out at around 2.5%. And locally, the RBA has signaled that interest rates will be put on hold at 0.1% until next year, despite market expectations for a rate rise. But the important lesson here is that cash rates will remain low, and this should continue to provide support for equity markets in the years to come. Also importantly, the RBA and Fed have signaled an end to quantitative easing in the coming weeks. And that's really money printing. And in the case of the US, the Fed Reserve have indicated that they will begin unwinding their enormous holdings of government bonds and other assets later this year. So there is no doubt that quantitative easing has pushed investors up the risk curve. And as a result, higher risk equities have enjoyed the most success as a result. But with the taps being turned off, the speculative mania that we've witnessed over the last few years is likely to come to an end. And there will be more focus on the financial health of companies, those that can generate sustainable cash flows to manage their balance sheet debt levels.
And in amongst all this, I think there's reason for optimism. Unlike the dot-com era, where many of the tech companies rallied on speculation rather than fundamentals, many growth businesses today in strong financial health driven by high profit margins and also high levels of cash on the balance sheet. Now, the chart on screen compares the market, the All Ordinaries Index, with their corresponding trend in rolling 12-month forward earnings expectations. And earnings expectations have continued to move higher despite the correction in prices. And although it's early days, the reporting period for earnings coming out of the US and Australia has been reasonably solid. So this fact should support our belief that the market correction should create opportunity for the conditioned investor.
Yes, and also, Matt, the reporting season has begun, and so we'd like to touch on some of our star stock highlights this week. Firstly, we've got ARB Corp. Now, positively automotive parts retailer and borderline star growth stock, ARB Corporation, they provided an upbeat performance update with first half sales expected to grow 27%, and that's well ahead of consensus expectations. And this is unbelievable given that new vehicle sales have been in decline with lengthy delays due to the shortages of semiconductors. Now, the reason for this is because there has been strong demand for extra equipment for off-road vehicles and SUVs. In fact, growth in the SUV division has risen over the last few months compared to a 12% decline in passenger vehicle volumes. As a result, earnings have been revised higher, and ARB is expected to generate positive revenue and earnings growth this financial year.
Yeah, good outcome for ARB investors, but the automotive space is seemingly better placed than other areas of consumer spending. For example, leisure footwear and apparel retailer and Star Growth stock and Star Income stock Accent Group noted severe Omicron headwinds over the first 4 trading weeks of the year. Retail foot traffic to stores is reduced due to consumers choosing to stay indoors. And meanwhile, high rates of COVID infection have had significant impacts on staff availability. The combination of these factors has resulted in an earnings miss of near enough to 10% compared to consensus estimates. But the company will likely be removed from our growth portfolio due to these significant impacts to earnings, although dividends expectations should remain intact given that they have been lowered to reflect the challenging conditions. So the stock is currently on a forecast gross dividend yield of 4.7%.
And moving on from retail, towards gambling following the number of failed M&A or mergers and acquisitions witnessed in 2021, Aristocrat, they take the mantle for the first failed bid of 2022. Members may recall that Aristocrat, they made a move on UK online gambling platform Playtech in October 2021. Unfortunately, only 55% of Playtech shareholders voted in favour of the scheme, with Aristocrat requiring at least 75% approval for the takeover to proceed.
And in a way, we view this positively because the acquisition would have severely impacted the financial health of Aristocrat, which currently has already elevated leverage ratios. Meanwhile, the recent equity raising of about 1.3 billion for this failed takeover could dilute its capital efficiency ratios, such as return on equity. So we need to await further instruction and commentary from the management on their future plans for that cash.
Yeah, that's right. And turning our attention now to the corporate calendar, it's going to be quite a busy week as reporting season kicks off. We have a bank-heavy week coming up with Suncorp and Commonwealth Bank due to release its first half result, while Macquarie and National Australia Bank, they are due to issue their quarterlies. Outside of the banks, there's Telstra, Baby Bunting, the ASX Limited, along with the REITs, Charter Hall Longwell REIT, BWP, Arena REIT. They'll be reporting next week as well. And for trend-sensitive investors, now Stock Doctor has the SD Max, which is the Stock Doctor moving average crossover, or the SD30 TSR, which is the 30% stop loss from or gains from its highs or lows. And for those who are highly trend sensitive, SD Max bearish signals were triggered on Altium, the ASX, BWP Trust, Nanosonics, and Nick Scully, while Suncorp Group, they turned bullish on the SD Max. Meanwhile, both Ares Resources and Objective Corporation triggered an exit on the SD30 TSR. You can find a full list of stocks that have triggered a bearish signal on the SD Max or the SD30 TSR in the watch list. In Under the Microscope this week, we direct our attention towards borderline star growth stock Ansell, which has fallen significantly on the back of an earnings downgrade. The company manufactures gloves and personal protection equipment for the industrial and also healthcare sectors. Some of the key issues were Ansell is forced to sell gloves that it bought during the height of the pandemic at elevated prices into a weakening market, so profit margins have been impacted. In addition, there's been labour shortages due to isolation requirements and shipping disruptions leading to higher wage and freight costs as well. And last week, its manufacturing facility in Malaysia was also ordered to shut down completely for a week due to rising case numbers. Meanwhile, one of its key suppliers in Malaysia has been banned from selling into the US over forced labour allegations as well. And although suppliers have begun to drop their prices, shipping lead times remain quite high.
That's right, Kien. And the company did try to push through price rises in January, but they've been unable to offset increasing costs, so margins continue to be eroded. And although most of the downgrade has come from those supply chain issues that you mentioned, demand for single-use gloves have also fallen back to pre-COVID levels. So the announcement has prompted analysts to downgrade earnings for the stock by over 20%, and this has resulted in significant contraction in its earnings for the year. So what should investors do with the stock?
Well, that's a great question. At Stock Doctor, the numbers tell us that its profitability, such as return on equity and net profit margins, will decline significantly this year. As a result, we will likely be removing the stock from coverage once it releases its results. But the stock price appears to be factoring the heightened active risk. And although much of these risks are transitory, we do not know when it will fully pass. And those who want to consider this stock as an opportunity should really fully understand these risks in our active risk section. Meanwhile, trend-sensitive investors should be out of the stock given that it's breached the SD30 TSR a while ago. Note also that the level of short interest on the stock has been quite high at between 4 to 5%. Now, with investor concerns of inflation and interest rate rises, the pertinent question this week is how should investors position their portfolio in the face of rising volatility? First and foremost, you should invest according to your sensitivity to volatility and stage of life. As you head towards retirement, your portfolio should be weighted towards the more defensive star income stocks, which are more mature businesses with a history of generating defensive earning streams, reliable income, and also have lower price volatility. Secondly, you need to remain well diversified and hold at least 15 stocks in your portfolio. This is especially important over the reporting season where one or two stocks in your portfolio could potentially disappoint, such as with Ansell over the week. And employ one of Lincoln's 4 strategies depending on your investment preference and risk tolerance. For the opportunists, take advantage of share price weaknesses to look for oversold quality stocks and rebalance your portfolio accordingly. And those who are trend sensitive could apply one of our technical indicators, the SD30 TSR or the SD Max, to help you enter and exit stocks.
In this stage of the market cycle, you want to avoid speculative investments. Avoid companies that are highly leveraged or unprofitable, and definitely steer clear of these newer asset classes with no intrinsic value that have emerged in recent years. Bitcoin, obviously, as an example, fell nearly 50% from its highs late last year. Now, for those of you with some cash on the sidelines and a risk appetite that can absorb the volatility, there's some great buying opportunities in the growth space. But many of you may be ill-inclined to add volatility at this moment. So position your portfolio towards high-quality, large cap income stocks. During periods of heightened volatility, you tend to see a flight to safety, and safety in this context is generally perceived to be found in large cap defensive names. Many of the stocks in our star income coverage fall into this category and have held up really, really well during the market correction. The chart on screen shows the ratio of large caps versus small caps in Australia. And when the line is rising, it means that large caps are outperforming small caps and vice versa. As you can see, the flight to safety has occurred in the recent correction, and it also happened during the COVID crash of 2020 and when the Fed began raising rates in 2018. You can also observe a similar pattern in our own coverage list. When income is outperforming growth, it typically occurs during these periods of heightened volatility and market corrections.
Yeah, last but not least, Matt, you can also play the inflation thematic, and that means taking advantage of oversold star stocks that tend to perform well during an inflationary and rising interest rate environment. And these include the banks, gold and material stocks, consumer staples like the supermarkets, and food delivery services as well. And you can find the list of these stocks by using our filtering tool and selecting the relevant sectors within our star stock universe. Anyway, that's all we have time for today. Thanks, Matt, for your valuable insights.
Thanks for having me, Kien.
And we also look forward to having Tim on our program next week as well. So stay tuned for that. To summarize, the market correction is healthy because they allow for sustainable long-term uptrends in equities. Also, volatility should be embraced because it creates opportunity to invest in quality businesses at great prices. And despite expectations of interest rate rises, cash rates remain low, and this should continue to support equities for the year ahead. Take care and have a happy, healthy, and prosperous week ahead, everyone.